Now, with the completion of section 1, we begin our section 2, which is mainly focused, or you can say, which is covering the cash flow and ROI. ROI basically means return on investment. That's going to be a next part of a section B. For now, we'll start with cash flow. So if you recall, cash flow statement is one of the important component of the financial statement. It is a part of the financial statement. So let's start to understand a bit what does cash flow means ideally. What is a cash flow statement? As the name suggests, cash flow is statement provides you with the entire scenario of your cash balances, the cash movements. When is the cash coming in? When is the cash going out? At what point of time you have surplus cash? What point of time you have a deficit cash? When do you need to arrange for the cash? When do you have excess cash to invest and earn income on that cash? And so on. I know it sounds a lot detailed, but it's not. Trust me. Once you understand the template and the components of the cash flow statement, it's going to be a really kid's job for you. So let's go ahead. I believe you must have been understood by now what is a cash flow statement. Okay, cash flow statement just provides you with the entire summary of your day-to-day, monthly, month-by-month cash balances. It can also be weekly. It gives you an entire summary of what point of time the cash is going to come in, from what source is it going to come in, for what purpose is it going to go out, for what reason, to whom the cash is going to be paid, and so on. Okay, so what is the need for a positive cash flow or a positive cash position? So first of all, before we understand the need for a positive cash flow or a cash position, understand the meaning of the term cash position or a positive cash flow. At the end of a period, when you're done with computing your cash flow statement, you might either have a positive side or a negative side. Positive comes in when your inflows are more than your outflows, and negative comes in when your outflows are more than your inflows. Now, why is it important for entity to have a positive cash flow statement or a positive cash position? It is because companies, or precisely here speaking for the project managers, they always need to hold a surplus cash to make sure they are prepared for unexpected contingencies coming up, unexpected emergencies coming up, unexpected expenses coming up. In a way, you can say that simple enough. Okay, that's one of the key factors. So, and when they have a greater opportunities, like but if they had a surplus cash to invest in a better machinery, they can yield better results for the project. So to capture the unexpected opportunities, also you need to be cash ready. You need to have a positive cash flow, and to make sure that you are not facing a cash crunch, so that your entire team or entire project is not under pressure to be completed on an early stage to recover the cash from the customers, because most of the time projects are based on deliverables, and when you have to rush up with the deliverables, there is a great chance of a compromise on the quality. So more than the financial aspect, the positive cash flow gives the project manager a peace of mind that yes, project is heading on a right track. They have a surplus cash to encash every opportunity which comes in their way, which they want to utilize. They are prepared for unexpected contingencies. They have a backup for unexpected expenditures arising on the way, and they have an opportunity to invest the excess cash in a better resources, which will help them to deliver the project in a better way. Okay, or you can say to improvise on their project to make the project more efficient and deliver it more quickly, and so on. So this was a small gist on why is it important to have a positive cash flow statement or a positive cash position. Now this this was all with regard to the aspect of a project manager to manage or to maintain a good cash flow position, a positive cash flow position. Also, there's one more important point which is applicable if the project manager is managing multiple projects. Supposingly, if the project manager has multiple projects on hand going on, if one of the projects falls short of cash and it is in dire need of cash to encash a good opportunity to pay off an unnecessary expenditure or so on, if the project manager is aware of its cash positions at any point of time, and he has a surplus of positive cash flow in the remaining projects and the other projects, he can divert the resources from project A to project B, which is demanding cash flow for the time being, and then when project B generates a positive cash flow, repay it back to project A. This he can do only if he has a good control over every project. He knows the cash position, the projected cash flows in the future period in and out for every project, and then he can use this temporary financing arrangement between his projects itself. So this was this was all with regard to why does the project manager need to maintain a positive cash flow or a positive cash position. Now cash flow from generating activities are classified into three categories. Okay, cash flow cash flow generating activities are classified into three categories. Cash flow generating activities are classified into three categories: operating activities, investing activities, and financing activities. So we'll go in depth for each of them. But remember one thing, as a project manager, you are mainly concerned with the operating activities because this is the area of activity on which you will be able to exercise the highest level of control. The investing activity and the financing activity, those decisions are mainly, or you can say decisions with regard to these activities are mostly taken at the corporate level. However, as we go ahead and see the examples, you'll be able to understand that to a certain extent, even as a project manager, you do exercise some control over the investing and financing activities. But the main area which is under your control as a project manager is the operating activities related to your project. So before we go into the depth of this and see an examples, I just want to give you a quick heads up as to what these three activities are classified as. The operating activities are those activities which are performed by the organization on a day-to-day basis. These are the core operations for any entity, and any activities which generate a cash by way of performing the day-to-day operations, those cash flow are reported in the operating activities. Let's say, for example, payment from receipt from a debtor to whom sales was made on credit, cash sales, your payment to creditors, the salary payments, your office rent, utilities payment. All these activities, if you realize, they are the core operations. They exist to support the core operations of the entity, and hence these all are classified as an operating activities. Investing activities, as the name itself suggests, when you have a surplus amount of cash lying with you, you don't just keep them in the bank lockers or in your company lockers. You need to invest them so that even they can generate ideally an income for the company, an income for the organization. So whenever the entity has a surplus cash and it invests in generate an additional revenue from that investment, it is called as investing activities. Now, it's not necessary that the surplus cash is generated only for the purpose of income, earning the interest income or the dividend income. No, many times the companies need to purchase a new asset, a new equipment, a new land, a new office building. All those things are done to support the day-to-day operations of the entity, but they do not fall under operating activities because they are not the core operations of the company, right? That's why these all the activities of are classified as an investing activities. One is whenever you have a surplus cash and you invest it in some bonds, securities, deposits, any kind of thing, and any purchase or sale of those securities are termed as investing activities, are reported as a cash flow from investing activities. Also, whenever you purchase any fixed asset, machinery, plant, equipment, also, or when you sell those equipment or those fixed assets, the cash flow generated from them is classified as an investing activities. And lastly, we have the financing activities. Financing activities are those activities where the entity enters into a financing agreement with institutions to raise capital for their company. It can be by way of a loan, by way of issue of new shares, and when they have a surplus cash, they can also buy back their own shares, repay out the loans, and stuff like that. So those are all classified as a financing activities. So I believe by understanding this different area of activities, you must have got an idea that operating activities are the area where you as a project manager have a greatest level of control. When you have some surplus cash, you invest it, but that's going to be a passive income for you. You cannot exercise much control in that area. That's up to the entity's policy also, whether it's allow the project managers to invest the cash or they ask them to return back the cash when they have in surplus and so on. So with this mindset, we'll just go ahead and see an example on the cash flow for, first of all, for an organization as a whole. Then we'll see a small cash flow statement which technically can be said relates to a project manager, how a project manager can prepare his own cash flow for his own project. Okay, we'll see that in the next session where we compare with both the examples simultaneously. Till then, I hope you had a good understanding of the cash flow statement. Make sure to repeat the slide again, at least go through the points again, because this is one of the crucial components for you as a project manager to analyze how do you manage your cash and analyze what point of time you need the cash, when is the excess cash lying around that you can invest in, and so other questions.